In this week's tutorial, we're going to look at a full exam question looking at IAS 7 statement of cash flows. So again, the first thing you look is the requirements for this question called Sapient. It's just simply prepare a statement of cash flows for the year ending December 2014. So I'm assuming you've read through the question already. If not, pause it, try and make an attempt to do it before you look at the suggested solution. So it's a very typical layout in terms of a statement of cash flow question. You'll be given 2 years of statement of financial position, giving you the closing balances for last year, which are the opening balances of this year, and the closing balances for this year. And you really only need 1 year's statement of profit or loss, which you need for the help explain between the opening and closing balances. So remember, the key focus of a statement of cash flows is like solving a puzzle. You have the opening balances, you have the closing balances, and you need to explain the movements, how you got from one figure to another in each line item. And if you do that correctly, your statement of cash flow should hopefully balance at the end. And how you use that is you use the information in the profit and loss statement and use the notes of the accounts to help you determine what exactly is the movements year on year. So going back to our slides from the core lectures, your first step in approaching a statement of cash flow is actually calculate the final answer. So often you'll see my working one will be, what is the movement in cash and cash equivalents during the year? So for Sapient, when we're looking at cash and cash equivalents, we're looking at bank and cash. We'll take that. Short-term investments we need to figure out a bit more because we know from the lectures IAS 7 has a particular definition around cash and cash equivalents. And we're told these investments relate to a 9-month deposit that matures on the 1st of February. And if the deposit was withdrawn before that date, all rights to interest are lost. The key thing here is a 3-month maturity or less. That's the definition for cash and cash equivalents. So it must be short-term in nature. Although at the end of December there's only 1 month left, all of January, it's still a 9-month maturity. So you look at the full maturity of the deposit, not just what's left at the year end. So in that case, this does not meet the criteria of a cash and cash equivalent. That's actually investment itself, and we'll be dealing with that movement when we get to investing activities in the statement of cash flows. The other key thing we should include here is the bank overdraft. That is classified as a cash equivalent under IAS 7. So we're looking at the movement between the start of this year and the end of this year. And that's essentially the final answer you're working towards. So if we come back and we look at, I'm just going to do it in Excel and I'll put this up on your loop page for working one. We're going to look at 2014, and we're going to look at 2013. And we're going to look here at the bank, and we're going to look at bank overdraft. And that will give us our total cash and cash equivalents for the period. So our bank in 2014 and 2013 were 610, and they were 300. Our bank overdraft then, we're told here, was nil at the end of the year, 0, and minus 100 at the start of the year. So the net cash and cash equivalents there were 200, and the net cash and cash equivalents now, let me copy it over, are 610. So that is a net increase of 410. So when we add up our operating activities, investing activities, and financing activities, the answer should be a net increase in cash and cash equivalents of 410. Now that is something that you'd always do at the start. So you actually know the answer you're working towards. That's why I say it's always like solving a puzzle. You'll be able to figure out exactly whether you're right or wrong. You're looking at cash and cash equivalents. The short-term investments do not qualify here because they do not have a maturity of less than 3 months in total. Right? They have less than 3 months left, but not 3 months duration or less in total. So that's always your first stepping stone, is to calculate the final answer. The second stepping stone then is set up a template, which are 3 key headings: operating activities, investing activities, and financing activities. And looking something like this here. Statement of cash flows, the key title, your operating activities, and leave a couple of lines, because we're going to have to slot those in as we go along, and leave a column to reference your workings. Then investing activities, same again, leave a couple of lines, and a column to cross-reference your workings, and financing activities. And then down the bottom, these are 3 key lines you will have in every statement of cash flow. The net increase, we know working one says it should be 410. So that's what we're working towards. This should really be 410. That's our net answer that we're working towards. We know our opening balance, if we go back to working 1, was 200. So you can slot that in. And closing balance, 610. So you can actually slot those in and get your marks. There will be marks going for that because it's a key disclosure requirement under IAS 7. So you have a template set up then, and as you go through the question then, you're slotting in information as you get it. So it's been much more efficient how you approach it overall. So once you have your template set up, we now start with the cash flow from operating activities. There's two ways to approach this, the indirect method and the direct method. You'll notice in my exam questions, I will not dictate which method you'll use. So in our recording here, we're going to use working 2. We're going to do the indirect method. Right. I will also give you in a separate tab the direct method, so at least you'll have the solution that way as well if you want to approach it that way. But you don't have to do both, you only have to do one and allow you the choice of which one you want to do. Starting the indirect method, I always start with operating profit, and that will be given. So I'll just tidy up this, I'll put the half pages so we're not moving the whole time. Make this a bit bigger. So your starting point there is operating profit. You can of course start with profit after tax, but you'll be just adding back expenses anyway. So the easiest thing is to start with the 930. Right? If you started with profit for the year 840, you'll be adding back interest and tax, and you'll be taking off interest received. So often it's often quicker to start with the operating profit if it's given in the question. You then do your non-cash adjustments. Right, so particular adjustments that are needed because they're either non-cash or they're related to another part of the question. So if we go down and have a read of the question, we're told in our admin expenses, there's a little asterisk. That includes the profit on sale of plant of 100,000. Profit on disposal, we take that off, minus 100, because that's a non-cash profit. The profit on sale of plant is not the cash item, it's the disposal proceeds that are cash item. And we'll get to that in the investing activity section. You have a loss on disposal also of equipment, and that's a non-cash expense. So you're going to add that back 20, because that would have been an expense in here, but actually it's not related to cash. So you take that out. They tell us in part A then, we need to know depreciation. Some questions give you depreciation directly. This one, it doesn't. So we're going to have to use here a working 3 plus working 4 to figure out what depreciation is. And we'll do working 3 for both. So we'll do the same working 3. There's depreciation on plant and depreciation we have on equipment as well. So some questions they will tell you what the depreciation is, other you're going to have to work it out using accumulated depreciation. So we'll come back to that then. Both of those are going to be working 3. Any other non-cash items? Included in admin expenses is 30,000 paid in connection with the share issue. What we do there is we take the share issue expense and you add back 30. And we'll say here, needs to go to financing activities. So the whole logic here is because that money is related to the issuing of shares, it shouldn't be in operating activities. So you add it back to operating activities and you'll take it off when you net it against the share issue proceeds in the financing section, financing activities. So it's not necessarily a non-cash item, but you're trying to match it relating to the particular area. This expense is 30,000 was incurred as part of raising new shares, which we can see up here, the share capital and share premium have increased. So we will net that amount against those proceeds later on in the question. This tells us about the disposal of the plant and equipment. We know we have the profit or loss there. That's fine. Some of you might go on now and put in the disposal proceeds straight away. I'll wait until towards we get that section. And then you're told dividends, they're not related to this adjustment either. So there's our key elements that we're going to figure out now how we're going to get to the indirect method for cash flow from operating activities. Our problem is now we don't know what the depreciation is charged for the year. However, we do have Generally, when the question gives you accumulated depreciation lines, they're going to expect you to calculate depreciation for yourself. So if we come down a couple of lines, we're going to do working 3. And we're going to look at accumulated depreciation. Accumulated depreciation here for plant initially. So when in doubt, try and do a T account. It makes it a lot easier to follow and understand, particularly the moving parts, because it can be quite complicated the first couple of times that you do a statement of cash flows. So if in doubt, do a T account. So we're trying to figure out, how did the plant balance brought down at the start of the year, 660 accumulated depreciation, how did that result in a balance carried down at the end of the year of 860? So again, what I said before, we're trying to solve the puzzle. So when you think about it, there's only 2 real things that can move accumulated depreciation. That is depreciation for the year, which is what we're looking for, and I'm going to put that in yellow. And also then if you made a disposal during the year, which we also had. So if we go down to the question, we know we sold plant during the year. Plant with a net book value of 600,000, which originally cost 1 million, was sold during the year. Right, so they don't actually tell us accumulated depreciation directly, but we know if the cost was 1 million, and we know the net book value was 600,000, accumulated depreciation must have been 400,000. So you're backing into the information. Again, you won't be spoon-fed everything, you have to make sense of what's given to you. So disposal here would have been 400. Think about the debits and credits for a disposal of property, plant and equipment, which you'll cover before in IAS 16. You would credit the cost account, credit plant cost, and we'll be using this information soon, 1 million. Now I'm just dropping the last 3 zeros when I do the T accounts, so if you're wondering why we're looking at just a million or thousands. So 1 million, you're going to debit accumulated depreciation for plant, 400,000, which is what we're doing here. You're going to be careful now, credit the SOPL, 100,000. And that's coming from the question. Profit on the sale of plant was 100,000. So by definition, they don't tell you what the disposal proceeds were, but it must be debit bank the balance, which in this case is 700. So we know that's going to be disposal proceeds for plant. Some of you will slot that in straight away, others will wait until we get to that section of the template. That's entirely personal preference. So that's an always useful way of the disposal. Look at the debits and credits, because you're going to make adjustments for each of those. So we know if the net book value was 600, we made a profit of 100, we must have sold it for 700. That's going to be the proceeds. And now we have enough information here to actually determine what the depreciation for the year was. The debit side was 1260. So to balance it up to get the credit side to be 1260 as well, you must have charged depreciation on plant of 600. That's your plug figure. So you're using that to slot it in to determine the indirect method for cash flow from operating activities. So we put that in, we're going to add back 600. And we're showing the examiner, you'll find that in working 3. Now if you're finding that difficult, pause it, go back over it, and then do the same for equipment. Explain how did accumulated depreciation equipment go from 620 up to 660. Very similar logic again. So it's important you put a bit of practice in here. Let's make this a bit smaller. So let's copy this down, and we're now going to look at the same thing for equipment. The balance brought down in equipment was 620. We're trying to figure out what depreciation should be. And we said the balance carried down is 660. So we're trying to explain how did equipment go from 620 accumulated depreciation up to 660. There's only 2 things that move it: the disposal and the depreciation for the year. They're telling us here equipment with a net book value of 60,000, which originally cost 200,000, was sold during the year. So that means accumulated depreciation must be 140. If the cost was 200, the net book value was 60, you must have removed 140 accumulated depreciation on your disposal. And again, think about the debits and credits. You credited equipment cost, 200. You debited equipment accumulated depreciation, which is 140. That's your net book value of 60. You debited the SOPL, 20. We know that because you're told in the question you made a loss on the sale of equipment. So again, you're piecing together those parts of the puzzle to make sense. So the balancing figure must have been debit bank, the difference, which in this case was 40. That is 40,000. Sorry, I should do 200,000 just to be clear. 140, 20, and 40. So your actual disposal proceeds there, 40,000. And that will be a cash inflow in your investing activities. And again, you can slot that in straight away if you wanted to in your template. So we can then figure out from accumulated depreciation, the debit side of the equipment T account was 800, so it needs to be 800 this side as well. The only plug figure that could have made it work is the depreciation charge for the year. They tell us Part A depreciation has been charged. They expect us to figure out that the plug figure there is 180. So you're going to add back 180 in the indirect method because that's a non-cash expense. It's reducing your operating profit, but actually it doesn't impact cash flow. So that means the subtotal, if we're looking here, when we do our cash adjustments, is 1660. And the only other element we have in the indirect method is working capital adjustments. These are nice and easy ones. You have inventory, you have trade receivables and trade payables. And that gets you cash from operations before you take off interest and tax. So for each of these working capital adjustments, it's a straightforward. You compare the opening and the closing balance. So here we're comparing 370 versus 410. Now be careful, this is a decrease in inventory. That is a cash inflow. You're going to add 40 there. So right there, decrease in inventory, positive for cash flow. So decrease in inventory is positive for cash flow because it's releasing money that's tied up in inventory. Trade receivables is 590 versus 290. That is an increase in trade receivables. Increase in trade receivables, negative for cash flow. So that's actually going to be minus 300. Because there's 300 extra in receivables at the end of the year, that's tying up cash flow. You're getting less cash in, so it's a negative adjustment when you're dealing with the indirect method. And finally then for trade payables, we go down. So we've dealt with inventories, we've dealt with receivables. I always just mark them as we finish with them. And we're dealing with now trade payables. It's gone down by 100. We're looking at 205 versus 305. And that means then it's a decrease in trade payables, which is negative for cash flow. It means you have less credit from your suppliers, so that is going to be minus 100. So inventory and trade receivables have the same direction. Increase is negative for cash flow, decrease is positive. Trade payables is the opposite. So when you add those up and you take all your adjustments overall, you get cash from operations to be 1,300, or essentially 1.3 million, because we're dealing here with the last 3 zeros taken off. So 1.3 million is your cash from operations. And again, if you want to have a look at the direct method, which is in the solution, it's up on loop, you can get to 1.3 million as well. So I won't be showing you both in this recording, we'll just focus on the indirect, which most students do, but just to prove it can be done through the direct method as well. So we can take that then in our template, we'll put cash from operations, and we'll say working to the indirect method, and then you're going to say 1,300. And I'm just going to put up here thousands to signify that the last 3 zeros have been taken off, just for neatness more than anything. So that's your starting point, to set up the template and do your cash from operating activities. What you now need to do then is interest paid and tax paid. So they're the next two adjustments you'll always do to finish off the operation side, the operating activities completely. So if we come back up first and let's look at interest. We want to know how much interest did we pay during the year. Well, we have an interest expense of 128,000. If we go and we look at the statement of financial position, we have no opening or closing liabilities for interest accrued. So that means whatever interest we incurred in the year, the 128,000, we must have paid. It must have been debit the P&L, credit bank. So all we put here is minus 128. Nice and straightforward one. And I put there SOPL to signify that there's no workings there. It's actually coming straight from the statement of profit and loss. So if there's no opening or closing liabilities, you don't need to worry about it. You can take it straight from the P&L. From a tax position, it's slightly different. We do have a tax expense for the year, 70, but when we come back up here, we have an opening tax liability and a closing tax liability. So it's not necessarily that we just paid the 70 during the year, there was a movement. Now the easiest thing I find for this is do a working. Do a T account out. Some of you will be able to do it a lot quicker without the need for a T account, but for everyone else, no harm in seeing how to do the T account approach to figure out tax. So your tax account and to figure out how to approach it. All right, let me just tidy up this. So your balance brought down in your tax liability account was 55. You had the SOPL charge for the year, which would have been debit the tax in the P&L, credit tax liability was 70. So all else being equal, we should have owed 125 at the end of the year in tax if we paid nothing off. The 55 we owed at the start of the year and the extra 70 we incurred during the year. We actually only owe 85 at the year end. So clearly there must be a plug figure here, and that's how much you paid the tax authorities, which would be credit bank debit tax liability. Because we actually don't owe 125, we only owe 85. So the amount that we paid to the tax authorities, tax paid, must be 40. And that would be a cash outflow. So again, you're using the information in the question to solve a puzzle. How do we get from the opening balance to a closing balance? And using the information then in the P&L and the notes of the accounts to explain that difference. So we can slot that in. Template working for minus 40. They're the key ones that go in. Now the last one, there is a choice. So you can put interest received here, or you can put interest received in investing activities. So as we go back and we talked about in the slides, interest received we often put in investing activities. I said there's a choice. It can easily go there if you want. You're not going to get dock marks, but just for consistency, we're going to leave interest received down here. And we'll do a little working on it in a second. So said there's a bit of subjectivity there where you put that interest received in. We will leave it until we get down to investing. So for operating activities, you tot them up, and the answer is 1132, 1.1 million. And that is your next key step then. So your first step, get the answer. We know that's 410. We have our template set up, and we have our cash flow from operating activities complete. Now, essentially, it's solving the rest of the puzzle. And the rest of the puzzle, if you go back to the question, is all the line items in the statement of financial position that are not in yellow. They are the ones that we haven't used or we haven't explained. And if we finish off all of those and we get the right plug figures, the whole thing should slot in and finish off the puzzle. So it's a nice question. A lot of students do like this to come up because there's a nice method to it as well. So let's take it from the top then. Let's look at the planned cost T account. So if I come back here now, this is working 5. And we look at the planned cost account. And we're saying what moves the planned cost account during the year? Right? Planned cost. So again, it's all about this mentality of understanding exactly what moves a particular T account and what plug figure you're looking for. So if I'm looking at the planned T account, I have a balance brought down, be careful on the debit side, because it's an asset, 2060, and a balance carried down on the credit side of 2860. So the difference there is the increase. Now, it's not correct to say, well, you must have bought 800,000 worth of plant, because of course what you're missing there is we disposed of plant during the year. Remember what I said up here, we had credit the plant cost 1 million. We've brought in the 400,000 accumulated depreciation adjustment. We've brought in the SOPL profit adjustment in our indirect method. We now have to bring in the 1 million and the 700,000 as the disposal proceeds. So the disposal there is 1 million. So actually this is 3860. And that must have meant you acquired property or plant in this case during the year worth a total of 1.8 million, which gets me to a closing 3860. So that is your plug figure. So if you left out or forgot about that disposal, you would have been caught there because you would have come up with the wrong answer. So the acquisition there of plant, 1.8 million. Right? And you can slot that in if you want, working 5. Acquisition of plant, working 5, minus 1.8 million. Be careful because it's an outflow. Disposal of plant, you can call it working 5 or you can call it what we did above, working 3. We said the disposal of plant, if you go back and look, up here, 700,000. The net book value was 600 and you sold it at 100 profit. So you can see, some of you will have that slotted in already. That's a positive 700. Disposal of plant. You do the same then, so we've explained the plant cost, we highlight it and are finished with it. There's no revaluation here, so we don't need to worry about a revaluation reserve. Same for equipment, we come down. We now do a different working 6 for equipment cost. The opening balance on equipment, 1140, the closing balance, 1260. So again, we're trying to figure out, well, if you just compared the two figures, you get the wrong amount because you're ignoring the fact that we had sold some equipment during the year. So actually, this would have been lower to begin with because you would have credited equipment cost as you were given down here, 200,000. So credit the equipment cost to disposal 200. That then becomes 1460. So this should be 1460 as well. And you're told all non-current asset additions were paid for in cash. So there's no amount owing for property, plant and equipment at the year end. So you must have credited bank and debited equipment, the amount of the acquisition, 320, 320. So that is the acquisition of plant or equipment, should I say, during the year. And we've already calculated in working 3, the disposal of equipment during the year was plus 40,000. So you have a lot of the stuff done as you go through. So if we come up, working 6, acquisition of equipment, working 6, we said was minus 320. Be careful with your positive and negative signs. And then, say of, and then your disposal of equipment, which we'll put back to working 3, was plus 40. Okay, so again, you're slotting everything, that every one that goes into the template is getting you extra marks. So remember that when you're looking at it, there is a lot of marks to be gotten. Even if you can't get the full answer out, keep going and putting in as much as you can. So that's another one sorted. Equipment cost. Now remember, we have interest received, so we'll slot that in as well. This is just the SOPL. There's no interest due at the start or end of the year. So whatever interest you earned, 108, you slot in, and that's positive. You've earned 108,000. It must have been debit bank, credit the SOPL, interest received. So you have a choice there putting that in operating activities. It's also fine in investing activities. The last piece of the investment activity then is the short-term investment. So you've gone from none to 1 million in short-term investments. If they qualified for cash and cash equivalents, they wouldn't go in at all. They'd go as part of the final answer. But because of the note to the question, it said it doesn't meet the criteria. Its term to maturity is too long. It's above the 3-month requirement. So what we're looking at then is the investment, short-term investments. You don't really need a T account for this. It's quite straightforward. I just say the SOFP. And be careful now about your positive or negative signs. So you've essentially increased your investments year on year. You've debited short-term investments and you've credited bank. So this is an outflow. So some students get confused with that. It's an outflow because you're putting cash somewhere else. You're taking money out of your bank and putting it into a short-term investment. So the debit and credit in 2014 would have been debit short-term investments, credit bank. Right? So that's an important one to keep an eye on. So that's an outflow. So there you have your investing activities complete. Significant money out in investing activities, partly financed by operations. And the last one you're left with then is everything else, which will go to financing activities. So the first clear one we have in financing activities is we have a share issue. Now some people will do a T account, others will just be able to figure it out from looking at here. And there's no problem either way, whichever one you're happy with. We're just going to look at it from the statement of financial position. The new ordinary share capital and share premium is now 2.4 million versus 2 million, which is a 400,000 increase. So you've clearly issued shares for 400,000 during the year, because you have to look at both of those line items together because they're impacted by the same thing. What you have to take off then is minus the 30 in expenses. So remember that, a lot of you might have forgotten from before. We said you add back share issue expense, that should go to financing activities. So we bring it in here to say you raised 400,000 worth of new shares, 30,000 of that was actually spent on issuing the shares. So the net raise was 370. The next one is retained earnings. Now, they actually give you a bit of information in the notes to say dividends of 40,000 were debited to equity during the year. You actually don't need to be told that. So if we come down to our next note, sorry, I'm in the wrong tab, here to working 7, let's look at here. We can look at retained earnings and prove that the dividends were 40,000, because in money exam questions you won't be told that. So the balance brought down in retained earnings at the start of the year, if we look at it, was 450. Your opening retained earnings were 450. Your closing retained earnings at the end of the period were 1250. And remember, there's only two things that move retained earnings during the year. This is working 7. And that is profits from the SOPL and dividends. So again, you're using your knowledge of what impacts key items. Your profit for the year was 840. So if we paid no dividends, 840 plus 450, closing retained earnings should have been 1290. The opening retained earnings plus the profits. The closing retained earnings are only 1250. So that is where the dividends of 40 must have come from. Now notice that's not dividends paid, because we have an opening and closing dividend liability to deal with. If there's none of that, dividends paid will be 40. But here, that's the dividend declared. Debit retained earnings, credit dividend payable. So we actually have to do a second step here, dealing with dividends payable, to figure out how much we actually paid. Opening dividend payables were 10, closing dividend payable were 30. And we know in retained earnings, we declared 40 during the year. So if we had paid no dividends this year, we should have owed 50 at the year end. 50 on both sides. We actually only owe 30. So we must have credited bank, debit dividends payable to 20. And that is the amount that goes in for your figure in the statement of cash flows. Now that's a tricky one. Don't expect to be told that dividends were paid at all. You should be able to figure out by looking at the reconciling the opening and closing retained earnings whether dividends were declared or not. And the other step is to watch out if there's any dividend liability on the statement of financial position. Because if there is, you have to make sure you account for that movement as well. So we highlight that and we highlight these. We've explained all of those. And you slot in the statement of cash flow dividends paid, working 7 minus 20, because that's a cash outflow. Right, so we have all our workings nice and neatly done, neatly labeled for the examiner, because you have to be able to see, and you'll get markings for every working you put in. And the last one then that we haven't highlighted, that's the benefit of highlighting them. If you explain everything in the statement of financial position, you're going to hopefully get the right answer, is the loan. So you're going to hear loan, and this is a drawdown of a loan. And that's coming from the SOFP. How do I know it's a drawdown? Because the loan has increased. So all I'm saying here is you're gone from 0 loan to 1.2 million of a loan. That means you got a new loan during the year. So in that case, it is debit the bank with the loan proceeds, credit the loan. So this will be an inflow in financing activities. If the loan was decreasing, that would be loan repayments, which would be an outflow. So sometimes it's fine to just say that is 1,200 versus 0 to show that it's just coming from the statement of financial position. You don't need to do overkill with the T accounts for the more straightforward ones. And thankfully, as we can see, when I add up my operating activities, my investing activities, and my financing activities, I get to the good answer of 410, which I have proved at the start, and you should do in the exam, what the net movement in cash and cash equivalents are from the opening to the closing position. So that's why I always emphasize that statement of cash flows is like a puzzle. It's you're moving between the opening and closing balances on the statement of financial position. And if you can tick them all off and find the plug figure that's related to the statement of cash flows, using all this extra information that's given, you won't be too far off. So it's a nice question whether you know you're right or wrong, and you can go back and investigate quite quickly if it doesn't tot up. So this week's tutorial was on the statement of cash flows, a full exam question called Sapient.